speaker is Professor Zabi. Professor Zabi is currently the Thompson Hill Chair of Excellence, tenured Professor of Accounting and School of Accountancy PhD Coordinator at the University of Memphis. He's currently appointed as the Honorary Advisor to the Financial Reporting Council in Hong Kong, December 2019 to September 2023. Key publications include 14 books on financial statements, mergers and acquisition, corporate governance, internal auditing, business sustainability, organizational ethics, audit committees, and forensic accounting. Many of the most important books has been translated into multiple languages: Spanish, Chinese, Persian, and Korean. Prof, over to you.
In my time, good morning, good afternoon to everybody. I'm Zabihollah Rezaee, Professor of Accounting and at the University of Memphis. And today's presentation is from one of my research on business sustainability and impact investing, implication for corporate governance, environmental, social initiatives. That comes from one of my recent books, textbooks that I have, and there are 4 modules. Module 2 relates on business sustainability, and basically the presentation comes from that. And I would like to start with definition of business sustainability as it is in my textbook. And basically, I define business sustainability as a process. It's a journey. It's not one event, with the key focus on 4 dimensions of sustainability performance, including economic, governance, social, ethical, environmental, sustainability performance. And it is more of integrated approach. It is corporate social responsibility is one of the components of business sustainability. And the purpose of business sustainability is to achieve financial economic performance for investor shareholders, to create shareholder value, at the same time having some environmental and social impact, or focusing on the achievement of non-financial, environmental, social, and governance performance to basically protect the interest of all stakeholders. The next slide, why business sustainability become important and why now? Well, to make it simple, sustainability information is demanded by shareholders, investors. As of now, more than 1,300 institutional investors worldwide with the 59 trillion of asset under their management, demanding non-financial ESG information. So that's one reason. Investors demand such information. Second, regulators mandate disclosure of ESG information. Starting in 2017, all large 6,000 European companies are required, or they have been required to disclose ESG information, including diversity and others. In Hong Kong, in Asia, and even in the United States, currently, the SEC requiring or has proposed or would require disclosure of climate change and human capital and so on. So that's for these reasons sustainability become important. And again, if you go to the next slide, the purpose is to create shared value for all investors. The framework that I use in the book is that the purpose of sustainability is to create shared value for all stakeholders. It's a long-term performance and multi-dimensional performance. And if you go to the next slide, I see the stakeholders that they have interest in the company and they take risk, including main one shareholders, government, environment, employees, suppliers, customers, society, and future generation. So you may ask that, is there any tension between economic sustainability performance, ESP, and non-financial ESG sustainability performance? Of course. There are some people who believe that when you take the money away from shareholders and spend on social, environmental initiatives and others, you take the money from shareholders. However, the main idea is that the companies that they conduct their business ethically, unlike Enron, WorldCom, they take care of their customers, they have a good reputation, they take care of environment and do the business of the customers, they're going to stay in the business longer and add more to their bottom line earnings. So sustainability focusing on long-term achievement of financial performance as well as non-financial. The section that the prior PowerPoint shows why we pay more attention to ESG. In 2000, could you go back to the previous one, please? Yes. In 1975, only 17% of non-intangible assets, including reputation, environmental, and others, was part of the market value of S&P 500. If you note here, by 2020, 90%. So businesses have all the incentives to focus on intangible assets, reputation, customer satisfaction, and other things. And the next page, I'm trying to, in the next section, focus on sustainability performance. Here today, I'll talk about 4 factors of sustainability, including performance, risk, and disclosure. Let's focus on performance. Next slide, please. With performance, this comes from ISO 26000 that we call that triple bottom line, focusing on human impact of the business, environmental impact, and financial impact. Basically, people, planet, and profit, not in the same order, but that's the focus. And prosperity is also added to these 4 P's. So you may say, 3 P's. So you may say there are 4 P's: people, planet, profit. And in my book, I focus on 5 dimensions of sustainability performance. Of course, the most important dimension is economic performance. This economic performance, the objective is to create value for shareholders, and companies show their performance in financial statements. These financial statements are audited by auditors that lend more credibility to financial statements. This dimension of sustainability performance is already established. When you go to governance performance, the purpose is to make sure that all corporate gatekeepers, they do their job and could be reported in corporate governance report, but who provides assurance on that is not well known. If you go to the ethics dimension, it is less established. Of course, every company has code of professional ethics, and then therefore should be a report on compliance with the code of professional ethics and some assurance of those. I'm still on the previous slide. If you go to the environmental performance, of course, the focus is on the basically having environmental impact and leaving better environment for the next generations. And the last one is social performance. You're going ahead of me with the slides. Need to go back. Yeah, here I'm done with this all the performance. Next one, basically, there are some research that shows that there is a relationship and link between financial performance and CSR and ESG, because focusing on CSR and ESG would have positive financial impact, would have positive impact on earnings quality, cost of capital, tax avoidance, stock prices, and so on. And there are some studies that really prove this association between financial and non-financial sustainability. In the next slide is about, could we go to next one? I wish I had the control over that. Another reason of focus, which should be more important to this audience, is that 17 sustainability development goals that was established by the United Nations, and by year 2030, these 17 goals are expected to be achieved by every company or in the world. For example, goal number 6 is a proxy for clean water and sanitation. 13 is related to climate action and climate change. 14 and 15 are applicable to nature and life below the water and life on land. So we already have this. Going to the risk, the next slide that I have shows the sustainability risk. And could you go to the next one? Yes, here, what we have in my book and research, I describe and explain several types of sustainability risk. The most important one is a strategic risk. Is the risk that company is not going to be sustainable in the long run by having wrong strategies, wrong focus on operational and financial and investment activities. The compliance risk is the risk that companies do not comply with applicable sustainability rules and regulations that I will talk about that shortly. Reputational risk is the risk that companies will not have a reputation of taking care of their employees, customers, and others, and that is important. And for that reason, many companies have established risk assessment and management, and the causal report, enterprise risk management, would help companies to assess and manage risk. Let's go to the next one. This about disclosure. In this section, I'll focus on disclosure factor of sustainability. Of course, Finland was the first country to adopt mandatory sustainability reporting in 1997. Other countries do that. As I mentioned, in Europe, starting in 2017, reporting on ESG become mandatory. And in the US now, we have the SEC climate change regulations and others. Let's go to the next one. Next slide, please. When there is a sustainability, there should be accounting for sustainability, which is the process of identifying, clarifying, measuring, recognizing, and reporting sustainability performance in all 5 dimensions of economic, governance, social, environmental, and ethics. That's what we call it, sustainability. And assuming that the companies worldwide start producing integrated sustainability report, this should be an organization to provide assurance, to lend more credibility to those reports. And as of now, there are several standards by Public Company Accounting Standard Board and the Standard on Assurance Engagement that helping auditors to provide some sort of assurance on non-financial ESGs. Let's go to the next slide, please. Yes, the question is how sustainability information can be disclosed by corporations. Well, if you go to annual reports or website of any high-profile company, the first thing that you see is we are sustainable, which means that companies like to disclose or tell their good stories about sustainability. So it can be in annual reports to shareholders, it can be in management discussion and analysis, or it can be a standalone voluntary or mandatory integrated sustainability reporting. And it appears that we are moving toward separate sustainability reports. We call it integrated reporting that being developed by standard setters. Let's go to the next slide, and I'll talk about the drivers of sustainability. Here is very important. There are, in accounting, if you cannot measure, it will not get reported. So in order to measure key performance indicators of non-financial ESGs, then we basically we need to have some organization to provide standards. That started with global reporting initiatives, G3 and G4. Then we have International Integrated Reporting Council, which focuses on integrated sustainability reporting. In the US, we have Sustainability Accounting Standard Board that works with the SEC to integrate sustainability into the filings with the SEC. The good news is that these organizations worked separately in the past. Now they are merging. They are merging into what you call International Sustainability Standard Board as of 2021. And that's a good step toward measuring non-financial ESG and helping accountants and auditors to focus on sustainability reporting and assurance. Next slide, please. I was told that I don't have much time. So what is the impact investing? What's the impact of that on sustainability on investment? Well, as you know, in August 2019, Business Roundtable announced that adoption of statements on purpose of a corporation, and more than 180 high-profile CEOs from Amazon, FedEx, including those, they came up with this statement that companies should identify their purpose. So we are talking about profit with purpose. Companies should not only achieve financial performance for shareholders, but also have some social impact and environmental impact. Let's go to the next one. I'm going, yeah. And then the next several slides, and I don't have time to go over them in details, are from Sustainability Development Goals. Let's move on. Let's move on. Here, the whole story is that the companies that conduct their business ethically, they take care of the environment, they take care of their employees, they have a good work environment, take care of their customers, they will have impact investing, they focus on profit with purpose, they tell their good sustainability story, they have a tone at the top, which means the board of directors focusing on the achievement of ESG sustainability by having either one directors with sustainability focus or having sustainability board committee, like audit committee, have sustainability board committee at the top, tone at the top. Then executives make commitments to achieve sustainability. For example, having part of the package, compensation package of executives being linked to achievement of sustainability. That shows the commitment by executives. Then focusing on all financial and non-financial aspects of sustainability, including economic, governance, social, ethical, and environment. And in the long term, if the companies do that, they add to their bottom line. So this is basically a link between non-financial and financial sustainability. I'm told that I don't have much more time, so I'm glad to answer any question that you may have. You can email me or ask question now.
Thank you very much, Prof. Zabi. We only have one question. What is your assessment of the sustainability risk put in place in the face of current global flooding and disasters?
That's the great question. What gets investors' attention is the risk. the risk of not complying with, for example, any rules and regulations, focusing on environmental rules and regulations related to global flooding and the disaster, but global warming, climate change. So these are the risks that relates to not complying with the climate change that cause this kind of problems. So the risk is the main factor that get investors' attention. If you don't comply with sustainability initiatives, rules, regulations, you would face the big risk. And one of them that mentioned by one of the audience is current global flooding and disasters. And we need to all work together. The companies, investors, regulators, and the community need to work together to leave a better environment for next generations. And that would address flooding and disaster and everything else.
Thank you very much, Prof, for a very excellent presentation. Thank you.
I appreciate that.